Friends, welcome to all of you. Welcome to a new lesson. Today, we're going to get straight to the point. That is, as I promised, no fluff, no unnecessary stories. Take a look at what we have here. Today, I'm going to show you the DOW strategy. I've named it that DOW meaning Dow Jones and Fibonacci. What is it all about? We know the fundamental principle of working in financial markets and the main principle in trading. One of the fundamental and most crucial key principles in successful trading is that a prevailing trend is significantly more likely to continue in its established direction after a temporary correction rather than to completely reverse its course. This is one of the axioms in the world of trading. So what does this mean in simple terms? When we have an impulse, a correction occurs, this is the correction. After this correction, it is more likely that the trend will continue its impulse rather than reverse. And this is a very important rule, especially if you have already determined that you are in a long-term uptrend, then you can keep working with this endlessly. Now, what do we need? So understanding this principle, what do we do next? We draw the Fibonacci retracement. Yes, so we have an impulse and we need to identify the impulse. We draw the Fibonacci retracement from the beginning of the impulse to the end. Notice that I use the Fibonacci retracement from 1 to 0. I don't use other levels. We don't need them. And in this strategy, in fact, we only need the following levels. I can actually remove the unnecessary ones. We only need the 0.61 level. See, I can remove the 0.38 and 0.5 levels entirely. They're not needed. So what do we know? We know that any correction can go as far as the 0.61 level. If the correction reaches the 0.61 level, it's considered a deep correction, but it's still a correction. We are still in an uptrend. Corrections can reach the 0.38, 0.5, and 0.61 levels. So 0.61 is that kind of boundary below it. Everything means the trend is already changing. Yes, I've already explained this. So when this happens, most likely the trend has changed its direction. That's it. Okay, so what do we need? To use today's strategy, we need several parameters. The first parameter is that there should be three consecutive bullish candles forming on the market, at least 3, but it could be 4, 5, 6, at least this number. For example, here is one candle, for instance, here is a second bullish candle, and here is a third bullish candle. So at least 3, but it could be 4 or 5. Each of these candles must have a wick. Naturally. In this case, the wick means that the high and low of the candle during the upward movement should each time set a new high, with every new high being higher than the previous one. This is an important condition. So our first condition is that there must be at least 3 bullish or bearish candles, where each new high is higher than the previous one, and each new low is also higher than the previous one. If, for example, at some point this wick does something like this, in this case, we no longer use this strategy. We need the wicks to look like this. At the very least, like this. If they are equal to the previous wick or lower, then that's it, the strategy doesn't work, and we wait for another entry. By the way, this strategy may not work on absolutely any time frame. I'll be showing it to you on the 15-minute chart. It's more or less suitable. You can use it on the 30-minute, 1 hour, 4 hour charts, in other words, on all time frames. Here, you'll understand where our breakthrough comes from. As you continue learning new strategies, you'll start to understand all of this. Here we have 3 bullish candles. So in fact, we have an impulse, here an impulsive movement. And after this impulsive movement, we need to wait for another 3 candles. That is, there should be exactly 3 candles, here not 4 or 5. Just 3 that do not make a new high and do not close below. And the third candle, should not close below the 0.618 Fibonacci level. So we draw the Fibonacci, and here we get new candles appearing. Here's our first candle, for example, here's our second candle, figuratively speaking. And here is our third candle, like this. So 1. Now, don't scold me for the image quality. It's not that important. What should we have here? After an impulsive move, which can be more than 3 candles, but at least 3, there must definitely be 3 candles formed. But these three candles must not, or rather the third candle must not, close below the 0.61 Fibonacci level. This is very important. This is very important. In other words, the candle can close higher. For example, this candle can drop down here figuratively and close, but then the next one opens here and closes at the top. Accordingly, in this case, it will have a long lower wick, just so you know. So this kind of pattern is also acceptable, but as a rule, you will rarely see this happen. Then the third candle can have a wick that goes below the 0.61 level and also rises above it with the same wick. This is also considered okay. So you can work here with confidence. Now, when the third candle closes and the fourth candle opens, right, as the fourth candle opens, as soon as it opens, you set a take profit of 0.01% here. If we're talking about gold, I'll be explaining this in terms of gold. 0.01% is actually 300 pips, which is $3 of movement right here. If you enter with a lot size of, say, 0.1 on gold, you'll earn $30 from this position, $30 at once. Okay? So if it's 0.01 lot, that's $3. If it's one lot, that's $300. Of course, you need to manage your capital properly. I recommend that to test out this strategy, you set up a demo account, put 10,000 on the demo, and work manually, that is. Use this lot size. Okay, that's it. Once you start using this lot size, you'll understand how much you can earn and how many positions you can open. By the way, I'll also show you now how this works in backtesting. So our first condition is 3 candles, the second condition. The third condition is that it hasn't dropped below the 0.61 Fibonacci level. And the next condition, and there's one last condition that you need to set on the chart. You need the RSI indicator on the chart, the relative strength index. Let me find it now. Relative strength index, or the relative strength indicator. Okay, important. Pay attention here. What is important to know here? First of all, most likely your indicator will be set to 14. That's the wrong level. Those are the wrong settings. You need to reset them to the correct settings, which is 4. Don't ask why. It's years of experience, and you'll understand why in a moment. So just set it to 4, trust me. In this case, you have no choice but to trust. We set it to 4. Now, what do we need to know? We need to set these levels. Yes. Everything you know about RSI, I'm going to gradually debunk this myth for you now. I'm going to share with you the strategy that I use. If it works for me, then there must be some sense to it, right? I recommend you try it too. You need to set the level to 61, and here you need to set the level to 39, just like that. There you go. So why 61 and 39? Because these are nothing other than Fibonacci levels from 0 to 100. If I meticulously stretch the Fibonacci sequence from its initial level, which is 0, well, roughly speaking, yes, all the way up to a significant level of 100, you will clearly observe that the 0.61 level, a crucial point, is precisely the same as the 39 level located here, roughly speaking, and conversely, the 38 level, another important point, corresponds to this upper level, indicating a clear relationship. Now, what do we know? Let's leave it like that. We know that as long as the asset is above the 0.61 level, for example, right now you can see we have the 39.68 level, so our asset, meaning we are in a bullish formation. So in fact, if we haven't dropped below the 39 level, for example, 39.5, 39, 40, 41, 42 are in a bullish cycle. So this is the last signal for opening a long position. We can be above it, yes, no problem. We can be, the main thing is not to go below the 39 level. As soon as all these parameters align at the opening of the fourth candle, we enter a long position. A long on gold will have its own take profit, silver will have its own take profit, Ethereum will have its own take profit, and Bitcoin will have its own take profit. To understand this strategy, you just need to run it through on different time frames, while also understanding the movement flow. Because starting from the first lesson, you will continue to build this take profit. You can also work on the 30-minute time frame using the same parameter, just on 30 minutes. Now, let's move on to practice. it's very important that you follow all these points. In the Telegram channel, I'll leave a PDF file where I'll outline all these nuances once again. So the first thing we need is to find that start right from the beginning somewhere, because now the question will come up. Where do we place the stop loss? We need to find, well, let's start from absolute zero. Right here, 3 candles that make a higher low and a higher high than the previous one. And okay, let's get started. So what do we have here? 1, 2, no, that doesn't fit. This one doesn't either. Hold on. This one doesn't work either, you see? Because it went down. Here, look, this is a good example. First candle, second candle, third candle. No, it doesn't fit, sorry. It doesn't fit. Why? Because after that, you see, our task is that when we found 3 candles, we draw a line along the top of the candle where we had the highest point. And in this case, this candle broke through the wick, so this strategy doesn't work here. All right, let's move on. We need everything to be just right. I think this one will work well here. Let's check now. Take a look. And right here, we'll probably have a stop loss as well. Let's see. Look, we have 1, 2, 3, 4 candles. Here's the impulse. 1, 2, 3, 4 candles. Okay. Great. No, there wasn't a stop loss here. This is perfect. You can see for yourself. Here we have an impulse for a long position. It started here and reached this point. Next we wait for 3 candles. 1, 2, 3. Here they are, 3 candles. Accordingly, at the close of the 3rd candle, at the open of the 4th candle right here, as soon as it opens, we set a take profit of 0.1%, or about a $3 move. This here is $3. Alright. Good. That is the conditions. What are the conditions? The condition is that 3 candles must be formed. This candle, as you can see, pierced the 0.61 level with its wick. It went higher. Accordingly, we can enter. Yes, the main thing is that the body doesn't close below. It doesn't matter if something else auto-closed, because we've already opened here a while ago. Moving on, the next condition is that at the moment when this candle closed, our RSI must be above the 0.39 level. Let's take a look here. Okay, here at the close, usually it reacts to the close, meaning that in fact, the RSI is calculated based on candle closes. So at that moment, the RSI was at 47. Excellent. So this moment is suitable for us to open a long position. Here we open a long position, and as you can see, it closes on this candle. Great. All right, let's move on. So here it is, the position worked out. We also work, let's maybe find the target position so you can check it as well. All right, good. Look, here's another impulse. We have at least three candles. Yes, there must be at least 3, but there can be more. Here it is, the impulse right here. 1, 2, 3. Here, the impulse started here. After that, here's the low. We wait for 3 candles. 1, 2, 3. This is the 3rd candle. If you look here, here's the 1st, here's the 2nd, here's the 3rd, at least 3. After that, another 3 candles. And the point is they should not rise or close above the 0.63 Fibonacci level. Yes, during a downtrend, we draw Fibonacci from top to bottom, and during an uptrend from bottom to top. We wait. 1, 2, 3. Here's the 3rd candle here. At the opening of the 3rd candle, we place it here. That is as soon as the candle opens, roughly at $3.01. Okay, this is exactly where the stop loss was. I can actually see how this works. All our conditions match, but we're missing the last condition. That condition is the RSI. Let's take a look. The RSI at the moment when this candle opened was at the level on, second on, 2, 3, right here. Yes, the RSI was also giving us a short signal at that time. And the asset drop by Abuter is our take profit, which it didn't reach, and we set the stop loss. Let me just tell you, don't rush to get nervous or say that I'm wrong, because I'm right. I'll show you later with long-term statistics. We set the stop loss at the point where the impulse started. Here's the impulse right here. Yes, the stop loss will be at this level. Those who are used to working with a 1-to-3 or 1-to-2 ratio will say this is nonsense and so on. Well, I don't want to insist on anything for now. So here we have our stop loss set. To avoid hitting the stop loss, yes, our robot has a built-in function, a trailing function. What does trailing mean? Yes, our take profit is set at $3, but as soon as it reaches the $1 level, it activates the trailing function. Why? It's very simple to avoid hitting the stop loss. Let's say you're trading manually and you hit the stop loss right here. Great. So you had a loss here, maybe around $50, maybe $60, $100. It doesn't really matter. So when you hit the stop loss, what do we do next? If you're working with a capital of 0.01 lots per 10,000, then after the stop loss, you switch to 0.02 lots and keep trading with 0.02 until you recover the loss. So for example, you had a stop loss of $100, you took a stop loss of $100. From then on, you trade with 0.02 lots. That is, each new order brings in about $60 in profit. $60. And you need to make at least 2 trades to cover that loss. If you had a loss of minus $300, you need to make more, let's say about 5 trades to close out that loss. As soon as you've closed out that loss with a profit, you switch back to the 0.01 lot size. This is very important. And this process continues on and on, perpetually unfolding and repeating itself. Over the vast expanse of history, we've probably encountered this kind of situation happening consecutively, time and time again, demonstrating a recurring pattern in various contexts. I believe the cyclical nature is a fundamental aspect of how things operate. Now, I'll proceed to show you precisely how this works in a practical application, because we also have a sophisticated robot designed to assist with this. How exactly does this advanced robotic system perform these tasks for you, streamlining the process and making it more efficient? Accordingly, you have the flexibility to implement this on different timeframes, adapting to various operational needs. However, it's generally not recommended to utilize this on very short timeframes, such as those that are extremely brief, because the duration of just 5 minutes is simply too short to gather sufficient data or allow for proper analysis, making it impractical for effective execution. So, once you've worked off the loss, you return again to the starting lot size of 0.01. In other words, it's a kind of martingale. Well, not exactly martingale though, but you get the idea. That's it. So I've called that. Now I'll show you how the robot works instead of you. This is where the whole secret lies. You can do this manually, and everything will work just fine, but take a look at the history. I'll show you the history, how profitable or unprofitable it was, whether it made sense or not. Now, together with you, we'll do a backtest. Hi, I've connected to another computer to show you this, because for backtesting it's more convenient for me to use a Windows computer. But that's not the point. Look, I'll be using this very strategy. The Fibonacci, meaning Dow Jones and Fibonacci, I'll set it to the year 2024, for example, from the beginning of 2024 to 2025. Today's date is 0506. Today is the 15th, right? Okay, that's it. Next, we set the parameters we need for work. If you want to work conservatively, you set it to 0.05. But if you want to work a bit more aggressively, you can raise it to 0.1. Robot. Next, you can set the stop loss, as I said, at the start of the impulse, or you can set it in points, or according to some other parameters you prefer. For me, it's set at the start of the impulse where it began, that's where it ends. Next, take profit. Take profit can also be set in different ways. I'll set it to $3 of movement, which is 300 points. Next, you can set slippage and spread. By the way, this is an interesting feature. If you want to work with a larger time frame, in fact, here you go. Next is trailing stop loss. If you need it, yes. Just like in our case, the robot can set it. Accordingly, the RSI period, as I mentioned to you, a news filter if you need one. By the way, this strategy can probably be used with prop firms as well. Honestly, I haven't used it with prop firms myself, but I think if you think it through, it could work there. That's it. You've set everything, set this up, enabled visual mode. Let's go. And that's it. This is how the robot works. See? Let's wait. We need to wait for at least 3 candles, maybe 4, maybe 5. stop. See, right here a long position was opened. Here's the start of the impulse. The robot immediately sets it up for you. Well, now we're gonna show how the robot works, but I need to convey to you that you can do this manually as well. And here you can see how your deposit increases or decreases in real time. See, we have the trading history. You can view all of this later. So our task is to understand whether the strategy works for the long term. That's it. We can see that the bot is doing its job here. In other words, you're not in front of the computer. While you're busy with your own things, the bot is working. Do you understand now where our business model comes from? That's the whole point. That's the essence of it. You don't need to invent anything. You don't need to create anything when everything has already been working for a long time and delivering results. So here it is, the result we've achieved. Here is the complete history of our trades. You can even see the losing positions here, the ones that were negative. For example, you see one stop loss with one volume, another stop loss. Then we made back all of that loss. Again, a stop loss, then a profit again. Each position is about $30. Every time we hit a stop, that's one stop, two stops, three stops in a row, four stops in a row. Then we made back all the entire loss. Oh no, we didn't make back the entire loss. We recovered part of the loss, then it hits a stop again. And then we completely recover all our positions. Now, if you look at the chart, you can see how it all comes together. Now you know our strategy. I hope you like it. Friends, if you want to get this trading bot, just write to us and we'll give you all the information. Peace to everyone. Goodbye.